Chasing dividends. I mean, why do those banks pay huge dividends? Is because they don't reinvest that for growth. That money they pay it out to shareholders. So it's not, as we know, it's not the best way to invest. Australia is really only one little tiny component of the investable market of what you can invest in out there.
Can you just unpack those a little bit, Billy, and how are they different to just say your average share portfolio or ETF that we might typically have some clients in? What are we talking about when we're looking at that private asset space, and why can it be appealing, and should people consider it?
Yeah, I mean, this is a huge topic, so we won't dive in too deep, but what does that mean, private markets, private assets?
Welcome back to the Winners Playbook. Josh here with Billy, just back from a quick trip to the US. Today we're going to be talking about what he picked up in meetings and sessions whilst he was over in the US and what it means for Australian investors. We'll cover private markets opening up to everyday investors, the risks of a few mega stocks driving returns, the real mood on US politics, and the differences between our systems. Billy, it's good to have you back, mate. How was the travel in a nutshell? Any sort of highlights that you can reflect on?
Yeah, thanks, Josh. It was awesome. It was one of the best experiences. It was one of those trips where while you're there, it seems like a long trip, and then as soon as you get back, it instantly fades in your memory, because we basically packed a lot into it, 10 days. What do we do? I mean, we did tours of Harvard and MIT. We met with a bunch of big fund managers in New York, and then we finished it off with a big conference festival thing in LA. So there was a lot going on, and we're in a group of like 24 of us, so like mostly financial advisors from Australia, and a handful of other people. So made some awesome connections and learnt a lot.
Yeah, I heard there was a story of you got stuck in an elevator. So can you tell the listeners what happened?
Yeah, that was rough. Definitely got PTSD for life from that one, because you're in New York, we're visiting all these different offices, like different fund managers, so going up to their fancy boardrooms and all that stuff. We got to one of them. I won't name names. We got to one of them, jumped in the lift, 8 of us, all from our group, so no sort of strangers in there, just 8 of us jumped in. Doors closed, the elevator drops about 1 meter, so it's like between the ground floor and the basement, and it just stopped dead, and that was it. We were there for 40 minutes in that elevator. There was no airflow. It was just slow. The temperature was slowly going up. It was like a sauna. Everyone's like dripping with sweat. No room to sit down, and so it was pretty brutal. A couple of the guys in there started telling jokes, which I don't know if that helped or made it worse, because you're sort of like 5 centimeters away from the next person. And then, they eventually, luckily no one sort of freaked out. They eventually got us out of there. We're in suits, drenched with sweat. And the fund manager that was hosting us, they were still pretty keen to press on with their presentation. So they said, get in the other lift and go up to level 34. And we're like, right, we're not putting all 8 of us in here this time. We're going 2 at a time.
Hedge your bets a little bit, huh?
Yeah, that's it. Yeah.
There you go. Mate, that's funny. That's a scary experience, I can imagine. I didn't, when I was in the US last year, I didn't get the elevator experience, but the MIT and Harvard was pretty cool. Who did you have at MIT? Did they have one of those geniuses presenting on, some of the latest? What did you get at MIT?
Yeah, that was definitely one of the highlights. It's like these guys are determining, the future of mankind there, pretty much. Like they're just at the cutting edge of any new technologies. We had this Russian dude, Vlad, or Professor Vladimir, whatever, I can't remember his name. And that was near the nanotechnology lab. So that was like the first lab where they were able to take photos of individual atoms. Right, so they showed us the incredible gear they used to do that. But essentially, they've got this lab where everyone who's working in there is in like hazmat suits. they remove all particles of dust from the air, and it's like nanotechnology. So like, making microchips smaller and smaller and all that sort of stuff. And they open this lab up to any companies that essentially want to use their resources and equipment to develop and test new technology. So it was just absolutely incredible. And, it makes you feel pretty stupid. Like you see this professor, you can tell he's dumbing down his language probably 90% compared to he talks to his students and stuff like that.
Yeah.
But yeah, it was just absolutely fascinating.
Yeah. Did you get to meet any of the students? Like when we were over there, we got to see some of the students who have created like some new companies that, some investors are backing and things like that. Did you get to meet any of those or?
We did also have a student give us a bit of a tour. Again, just like incredibly intelligent people you're dealing with. And then same at Harvard, we had some genius give us a tour there. But like one example, I guess one practical example this guy was giving us, he said, like when you put solar panels on your roof, a big chunk of the cost is installation, right? You have to send guys up there to install them and all that stuff.
Mm-hmm.
He said like they have the technology to make solar panels that are essentially like a thin roll-up carpet that anyone could just climb up on the roof and just roll it out and nail it to the top. And it would just like half the cost of solar panels straight away.
Yeah, wow.
But he's like, the way that works, like to make it commercial and all that stuff, the way it works, it'll probably be 10 years until you actually see that happen.
Oh, there you go. Yeah, it's fascinating, isn't it? Yeah, it really is. Yeah, there was some real good ones when I was over there as well. And yeah, obviously some of the fund managers over there see that as an investment opportunity and get in right at the beginning of these, little seed companies that grow up into being like some of the biggest businesses around, which is probably going to be a little bit of what we're going to be talking about today, is that like private equity space, which a lot of average investors don't actually get any exposure to. But before we jump into that, were there any like particular big takeaways that you had there, Billy, that you reflect on now that you've only been back for about 24 hours, of course, and maybe a little bit foggy still, but yeah, any sort of big takeaways that you can talk on?
Yeah, I mean, I've got a whole bunch of notes I sort of need to sort through and organize, but I mean, the main thing, you probably experience this too, like Australia's just so small, like in the scheme of the global economy and what's happening in markets and everything else. So that's really the main reason to, if you're lucky enough to do these sorts of trips, to do them, is it just opens your mind to like, what's happening around the rest of the world.
Yeah.
Because if you rely on the media to deliver you that information, it's not really helpful. So yeah, just really opening your mind and seeing what's out there and how they do it in particularly in the US, because it's really the home of wealth and innovation and all those sorts of things.
Mm. Yeah, I think that's important for like any sort of business, whatever sort of area that you're in, is like you're getting out and seeing other countries and how other people are ultimately doing things, because you never know, just like one little piece of information you get might be able to come back and translate into your own business, and it completely changes the trajectory of your business. So I think it's you kind of get stuck in your own little shell when you just go to the office, go home every day, stay in your own little ecosystem. Every now and then, I think you sort of got to rip yourself out of it and just throw yourself out there, and just, you never know ultimately what can come from it. And yeah, you're obviously not wrong in the fact of, some of the biggest and best businesses are all over in the US, and I don't know how that's going to change anytime soon. I don't think Australia is necessarily going to, pick up the slack there. And hence why, in our investment portfolios, we're generally more overweight international equities as opposed to Australian. Whereas, the average investor in Australia who doesn't have advice probably has that home bias where they just would invest in Australian shares as opposed to looking at some international exposure. Do you see that often, Billy, for clients that you're seeing before they get advice? Like, do they generally have any exposure overseas, or what have you seen historically?
Yeah, well, that was another big takeaway from the trip, is that obviously they're a bit biased. We're in the US, but it doesn't seem like that theme is changed at all. Like just their mindset is like innovation and growth and all that stuff, and who the president is or whatever doesn't really seem to change that at all. Like they really played down the politics had any effect on them whatsoever.
Yeah.
So yeah, certainly when we see clients who have that old school Aussie portfolio where it's just like 4 banking stocks and
Give me those dividends and franking credits. Let's go.
yeah, chasing dividends. I mean, you know, why do those banks pay huge dividends? Is because they don't reinvest that for growth. That money they pay that to shareholders. So it's not, as we know, it's not the best way to invest. Yeah, Australia is really only one little tiny component of the investable market of what you can invest in out there.
Well, what if we start talking about some of that other universe of investments that exist, being the private asset space, which is an area that we're looking very closely at in terms of how we can get our clients exposure there moving forwards. And really the big classes of that we would look at there is that private equity, private credit, and infrastructure. Can you just unpack those a little bit, Billy, and how are they different to just say your average, you know, share portfolio or ETF that we might typically have some clients in? What are we talking about when we're looking at that private asset space, and why can it be appealing, and should people consider it?
Yeah, I mean, this is a huge topic, so we won't dive in too deep, but you know, what does that mean? Private markets, private assets. Well, the other side of things is public markets. Like that's a share market. Like you can go on the share market and buy shares in public companies, i.e. they're open to the public to invest in. Private markets just means it's not public, you know, not listed on the share market. And the trend over the last few years in particular is businesses are choosing not to list on the share market, right? Because the amount of compliance and regulation and cost and everything else that's involved in listing on the share market, businesses have decided it's not worth it. So they're going to private investors. That's what private equity is. Private equity is simply buying and selling businesses, right? But they're not public ones. It's done privately. That market is, you know, it's bigger than the share market. And so you can invest in this stuff. The barrier is it generally hasn't been available to just everyday investors. It's been confined to like institutions, like big super, like industry super funds, other pension funds around the world. Like, you know, their minimum initial investment might be $1 million into a private equity fund. That's what's changing. And that's one of the reasons I went on this trip, and same one of the reasons you went on the same trip a year ago. That is changing. And we're very, very close to getting to the point we can give everyday investors access to these things. They spoke about it a lot in New York. And the reason we have to do this is the share market is increasingly limited of like what you can actually invest in. Like in Australia, it's 4 banks, 2 supermarkets, 3 mining companies. That's like half the share market. And the share prices are too high. Like it's really expensive to invest in those things.
Yeah.
So the risk is, you know, there's a big downturn one day and those share prices get absolutely smashed. The same in the US. There's like 7 or 8 gigantic companies, you know, Microsoft, Apple, Amazon, etc. And their share prices are astronomically high. So if you only buy index funds, you're like ignoring, you know, more than half of the other companies out there that you can actually buy in private markets.
Yeah.
So that's why we've been doing a ton of research into what's the best way to do that.
And I
for
think
us
it was
and for our clients. Yeah.
Yeah, and I think when I was over there, they were saying it was about 80% of companies these days don't want to go public; they stay private. So if you're only investing in that listed asset space, being the share market, and you're buying shares on the stock exchange, you are actually missing out on some of the best companies around the world because of it. But that, you know, the average investor is not probably going to think any differently around that, because they're just going to think about always just investing in the share market. But I think naturally over time that might change, and as more exposure and more investment vehicles come out to be able to get exposure to the private asset space, is naturally only going to push more fun ultimately into that. But what about private credit and infrastructure, Billy? Like what on earth are we talking about when we're talking about private credit and infrastructure? What is that?
Yeah, private credit. So I knew almost nothing about this 2 years ago. And I mean, spent a ton of time learning about it over the last year or two, in particular, private credit. So in the same way a company doesn't want to list on the share market anymore, they also don't want to borrow from a bank anymore. They don't want to borrow money from a bank. They want to borrow money from private investors in private markets. And, you know, why do they do that? Well, firstly, the banks are losing, particularly in Australia, they're losing interest in lending money to companies. They'd rather just lend money to people to buy houses. And also if a company wants to borrow money from a bank, they have to disclose all their financials to like a range of banks to try and source a loan. And yeah, often the banks aren't interested. So now they're borrowing money from private investors. That's called private credit. And you can invest in that stuff as well. And a company, if they borrow in private markets, they will pay a higher interest rate than what they pay if they borrow directly from a bank. So the returns are like pretty amazing. Like one of the biggest private credit funds, we went over there and they're creating like high quality loans. That pays a 10.5% yield, 10.5% income you can earn if you invest in this private credit fund. It's a huge fund. It's like 5,000 loans and they're like high quality loans. I mean, that's just incredible compared to alternatives.
Yeah. And
compared to a term deposit giving you 4%.
And if you use that example, do you remember off your head, like that fund in particular, did it have a minimum investment size of like what you needed to be able to get exposure to it? Or
I don't know off the top of my head, but like most of these funds, bare minimum would be 100 grand, maybe 250 grand. But also you have to satisfy, the sophisticated investor test.
Yep.
So you have to have millions of dollars in assets before you're like permitted to invest in these funds. And that's the issue, and that's what we're solving. That's what we have to.
Yeah, no, I agree big time. And what if we talk about then, timeframes and in investing in this stuff? Because I know that with some of these investment options, they're not as liquid, meaning you can't just sell in and out like a traded stock on the exchange. So how's that generally working with some of these private assets? Because it's not as easy to get your money sort of in and out, is it?
Yeah, spot on. Classic private equity, like old school private equity, you'd invest your money and you wouldn't get it back. You might get it back for 5 to 7 years. So that only suited really wealthy people because they can carve off a chunk of their wealth and invest in that, and they don't care if they wait 7 years because they're prepared to do that to get a really good return.
Yeah.
So to solve that issue, there's funds these days that are called evergreen funds. So it means you invest in this private equity fund and that fund might own 200 businesses. So they might buy a business, sell it 5 years later, but they're constantly rolling through deals. So they're constantly buying and selling businesses. So if you invest in a fund like that, you're not locked up for 7 years. Right? You've got pretty good access to your money.
Yeah. And is that some of the risks, like with the private asset space? Is it more around the liquidity? Obviously, the fees are generally going to be higher with some of these funds. But the way I always talk about that with clients as well is, that what you should be concerned about is your net return. What are you getting after fees? Yes, like if a fund is charging you, say 2%, which is a pretty high investment fee these days, but they're giving you net every single year over 10. That's a good investment. So you got to look at that gross versus net return. But yeah, what are some of the other risks that exist in that private asset space, Billy?
Yeah, so fees is one. As you say, it's all about the return after fees. That's all you care about, right? You're happy to pay more fees if you get a higher return.
Yeah.
The big one, and we heard this word about bloody 20,000 times, is the word liquidity. So if you invest in public share markets, a big advantage is you can click buy or sell whenever you want and you get your money 2 days later.
Yeah.
In private markets, that's not the case at all. It's not, because they're not publicly traded funds. They're not like on a stock market where there's buyers and sellers there all day, every day. That's both an advantage and a disadvantage. Disadvantage is you're not guaranteed access to your money whenever you want it. But a huge advantage is what's called the illiquidity premium. So because you don't have guaranteed access to your money every day, you would expect a higher return. You'd expect better performance. And what happens is, for the most part, you do have access to your money in these funds. Like you can generally get a hold of your money within a month. But if we have an event like a global financial crisis or some sort of like scary economic event, if everyone tries to sell at the same time, the money's not there, right? Because it's invested in all these companies. So you can access your money unless too many people try and access their money at the same time. It's bad if you need your money, but it's good because it will force you not to go and click sell out of fear, like when everyone else is selling.
Yeah, that's interesting. It's good and
It's
bad.
actually a good thing philosophically. Yeah. Like when you invest in these funds, you know, right, I'm locking up this money. This is a long-term investment. So I'm not going to worry about like the news cycle and what's happening in a given month because this money's invested 10 plus years and I'm just going to ride it.
Yeah, and I think that's quite similar when I'm talking to clients about the differences between investing in the share market and the property market, because there's this perception that the property market's a hell of a lot safer than investing in shares. And I think part of the reason behind that is the daily valuation of the share market.
Yeah.
And I can look at my account every single day and it's like up, down, 5, 10, here, there, 2, flat, whatever it may be. And it messes with your psyche. Like it just absolutely messes with your psyche. Whereas, you know, you spend a hell of a lot more money generally when you buy a home. So you're actually deploying way more capital, but people are less conscious of it. They don't think about it nowhere near as much, even though they should, because they're doing the opposite of diversifying. They're investing in one asset generally, in one location, and a whole heap more money. They're way more concentrated, but there's this weird, perception that it's safe and that you're guaranteed going to make money, which you always won't. But I think it does come down to that daily valuation. And that's where some of, like you were just talking about then, is although it's problematic if you can't get your money out, it can also work in your favor as well, because then you're not inclined to try and pull out when everyone else is or when the markets are down, and you ride the wave. And, you know, if it's not valued on a daily basis, well, you're less inclined to go in and look at it, and it's more likelihood you're going to hold it for as long as you should, longer term. So I always say to people, like, if your letterbox had your property valuation there every day, you would think a lot differently around the property market, but obviously that's not how it does work. But I think it's quite similar to the private asset space. Would you say, Billy?
Yeah, well, it's exactly right. And like a classic example is in April this year when Trump announced his tariffs, share market fell 9% in one day.
Yeah.
Right. And we know people who sold or wanted to sell that day and went on to make record highs, a few weeks later. If you're in one of these private equity funds, you wouldn't have even thought about selling, right? You wouldn't have thought about it. And the value of those funds didn't move because the businesses in there are valued, 2 times a year.
Yeah.
So it's sort of it's not necessarily a bad thing. It's just like, again, like don't put all your money into one investment. Like make sure you've got your liquidity, like got your cash and money you can access quickly.
Yeah.
Whatever you've got over and above that, you lock that away in long-term investments.
Yeah. And going back to a point you said a little bit earlier around that, like high concentration in the US and Australia to a small handful of companies, being like more the banks and the miners here in Australia, and then over in the US, it's quite tech heavy. What are we looking at there when, how do we sort of diversify our clients away from that or out of that or managing it? Because if you just stick them in the index, like you said, they're pretty much investing in just a small handful of companies, which is not where all of the value is going to be lying, and you're missing out on so much. So how do we do that for our clients, as opposed to we just whack them in the index and it's just going to track that standard market return?
Yeah. So like, as you know, with the way we invest clients' money at the moment is we don't just put it all in, an S&P 500 index fund. Like we don't put all their money just in the US main share market index, because then you will have a third of your money in that handful of companies. We're looking at share markets all around the world, and we're also using funds that aren't investing in the biggest companies. They're looking at like small and medium-sized companies as well. So we do that, and then in some cases you might have an investment property or other investments there as well. So it's just about having like this well-rounded portfolio rather than just whacking all of your money in one, American or Australian share index fund.
Yeah.
And with just private markets, that's obviously the next level of diversification and potentially better returns as well. So that's why we're really spending a lot of time looking into it.
Yeah, well, and when I was looking at it as well, and obviously continuing to look at it, those net returns were generally being targeted between sort of 10 to 15%. Is that what you've seen over there with most of the private asset space? Is that generally the the realm of what we're considering when we're looking at those returns?
Yeah, so private equity funds generally target 12 to 15%. As a what's the share market is sort of 8 to 10%. So if you can get 12 to 15, you're stoked. Especially with less volatility, like the share market falls, the private equity funds, if you've got good managers there, it shouldn't fall in the same way through the tough periods. And then the private credit funds, which you would consider to be lower risk and also more liquid, like your money's less risk of being locked up in those funds because they're just loans that are constantly rolling over.
Yeah.
Those funds at the moment, they're targeting sort of 8 to 10%.
You'll take it.
Way above what you generally get in fixed interest. And then that's sort of linked to interest rates. So if rates fall, like back when rates were 0 a few years ago, those funds were sort of doing 4 to 7%. Whereas in a term deposit, you're getting like 1% back then.
Pretty much losing money at that point after inflation. Yep. You're going backwards. No, cool. That's good to hear, Billy. And what about from the politics side of things? When I was actually over there, it was just before the election. So I remember being after one of the nights that we went out and we were in some pub, and I was having a chat with some guy, some young dude, and he was talking about, I was like, oh, who's going to win, Biden or Trump? Because it was when the debates were happening. Actually, it was the night of the debates, and we were in there, and he was a Trump supporter, so he was giving me his views on the world and all of that. But obviously Trump's now in, there's lots going on over there. Was there much talk on US politics with the fund managers and their views, or is it kind of a bit of a non-event? It's always the same differences here and there, and you just get on with it?
Yeah, that was it. Before I answer that, didn't you meet old 𝗏𝗏 when you're over there?
Yeah, we actually
𝗏𝗏.
And I tell you what, a couple of the tips that he gave us have actually paid off with
Really?
He spoke a lot about some investments, and a few of the guys I know put some money into those, and on 𝗏𝗏, his hot tips have actually paid off quite well. So you didn't get the 𝗏𝗏 experience, did you?
No.
Wasn't in town.
No, we didn't get 𝗏𝗏. I was hoping, but no 𝗏𝗏. Must be busy. One interesting one of the interesting sessions we had. You met these guys as well, like a 𝗏𝗏𝗶𝗃𝗃, like one of the oldest sort of private equity funds out there. And by the way, their funds have averaged 18% a year for 50 years.
That's astonishing. Which
is just insane. They said the worst performing fund they've ever run did 10% a year.
They still take it.
It's just like, this is what the wealthy are doing. So we need to get amongst this stuff, and we will soon.
Yeah.
But when we went and saw them, like all these big fund managers, they obviously need to know what's going on with politics. So 𝗏𝗏𝗶𝗃𝗃 had this guy who was the press secretary to Bill Clinton. And then he worked under Obama as well. So he gave us a little rundown of what they think of politics right now and where it's going and all that stuff. And it was pretty it was nothing dramatic, to be honest. He said, this guy's been in politics for ages. He said, Trump's in his second term. He will not be president when that term's finished. Even though he likes to joke, oh, I'm going to stay on and get cheers and all that. He said, it's not going to happen. It can't happen. And he said, when a president gets into their second term, everyone's just thinking about what life looks like after that person's gone, because they know they're going to leave. The amount of power they have is sort of slowly diminishes as they get towards the end of that second term. And he said Trump's policies are generally they're nowhere near as dramatic or impactful as the media likes to portray.
Yeah.
So they just said it's really business as usual for them. The tariffs have an impact. But aside from that, they didn't really think there was really much to be too worried about. And one of the other fund managers had a political commentator as well, and she said the same thing.
Yeah, right. Are you saying the news is a bit of scaremongering? Is that what you're saying, Billy?
Yeah, we all know it, but sometimes we need a reminder.
Yeah, I tell you what, I don't watch the news often. It's very, very rare. And that's why I think most people really, podcasts, people consume so much of their information through podcasts. And I think that trend is just going to be something that just continues on forever into the future. I think it's happened a lot more over in the US, that change. I don't know if it's happened so much here in Australia, but I think that trend just naturally continues into the future. Final question that we've got for you, Billy. What about the differences between the US advice model and here in Australia? There was some real stark ones that stood out for me when I was over there last year. Just keen to see what that looked like for you, and any sort of key differences that you can look at between the US advice model and the Aussie advice model.
Yeah, well, this is the one thing where Australia is miles ahead of the US, in my opinion. And it's partly because we had a, Royal Commission into banking and a mountain of regulation thrown at us. It's resulted in our advice being super high quality because we're really forced to really consider our clients' goals and their lives and what they want to achieve and all that stuff. Whereas in the US, they're still really focused on just investing money and, here's $1 million, what do I do with it? And then building a portfolio. And they're a lot more confined to that. Whereas here, we have way more impact to our clients because we're trying to get to know them and figure out what's important to them, what they want from their life, figure out how to do that. And we charge a direct fee to our clients and they know what it is and they pay it, as opposed to in the US where they're still getting they're tied in with the investment products. So they're getting like commissions and incentive payments and all this stuff. So it's still a bit more of a like product sales investment focus. Whereas we're way more like well-rounded in how we deal with clients.
Yeah, and that was the exact same when I was there. Hasn't changed, and that was very similar, obviously, when we just got back from Singapore, and the how the advice is being provided over there very, very, very much feels like ancient in a way, where the advisors are commission based. Clients don't know what they're actually paying for, and they don't get disclosed, and you just think that some of these markets are absolutely prime for some regulation to come in. But also worthy of noting, in Australia, there are some differences between advisors out there. Like, I would say our firm's holistic. We give holistic advice, which I think is the only true advice that you can actually provide, but not to knock that there are other types of advisors out there that will just sort of specialize in one area. And that would be, predominantly investments. You'll have some advisors that basically all they will do is just manage your money and invest your money. And then anything outside of that is not really in their wheelhouse, and they'll refer it out to other specialists or whatever it may be. But I genuinely love working in the holistic advice space because I think that's where you can ultimately provide the most value, because you're still looking at the investment piece, but you're also broadly considering much more around their circumstances and not just necessarily around investing their money. So that really doesn't sound like it's changed at all, Billy. Before we close out, mate, any other highlights or any other points you think worthy of noting about the US before I let you go and enjoy some time with the family and recoup?
Well, something very exciting for you and I and the listeners out there is there was a couple of other podcasters on this trip. So
Oh yeah, cool.
I was hitting them up about how to make a great podcast. So there'll be more developments to come for the Winner's Playbook, I think.
Yeah, well, you probably would have seen that video I put out, Billy, of the office that we've got on the way. So we're only a few months out now from moving into the new office, and I can promise all of the listeners the podcast game is going to step up big time. At that stage, we're going to have the booth set up. We're going to have a lot of different guests coming in and out of the podcast as well, some big names in there. So very much looking forward to getting into it. But other than that, Billy, we might close out. So appreciate everyone that is listening. Of course, if you're getting value out of what we're talking about, 5 stars on Spotify and Apple. And of course, if you ever want to chat with an advisor around your own circumstances and what you're doing with your money, your life, or getting a plan for the future, you can reach out to any of the advisors at Link Wealth, or of course, any financial advisor out there. So until next time, Billy, enjoy your weekend, mate, and I'll see you next week.
Thanks, Josh. See you Monday.
Disclaimer. The information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you wish to book in a free 15-minute call to discuss your personal situation.